Welcome to my audio lectures on inventory. This is going to be a three-part series, and the first part is about what happens, what are the journal entries when you purchase things to sell. Now, the normal process or relationship, we have three. We have the manufacturers, the people who make them, the wholesalers who buy them to then turn around and sell them to retailers, or you can actually have manufacturers go directly to retailers. So in this case, what we're going to focus on are journal entries are going to be on this part, which is a company that sells the goods to the customers. And these are the journal entries we're going to be doing. Now, when a company buys goods to sell, there are two types of transactions to journalize. First, you have the purchase of the goods for resale. When the goods are purchased, they are treated as an asset. We call it inventory. When we must include all costs associated with getting them ready for sale, which include any freight-in charges, purchase discounts, or returns. Now, what happens when we sell these goods? Well, when goods are sold, they are no longer an asset, inventory, and instead we have to take them out of inventory and treat them as an expense, which we call cost of goods sold. So remember, cost of goods sold is an expense account, and it only appears on the income statement. We must also book the revenue generated, reduced by an estimate for sales returns. On part one, we're going to focus on what are the transactions for buying goods for resale. Now first, there are two inventory systems. First, there's the periodic. This is usually used by really small businesses or drugstores, where what they do is they go out and count how many things are on the shelf, and that determines what they have in ending inventory, and they assume everything else is cost of goods sold. So, inventory and cost of goods sold are determined only after a physical inventory is taken. Now, very few companies use this method, except, like I say, if they're a small company and can't afford barcoding. Now, the method we're going to focus on for our journals, and these are the easiest journals to do, are when we do a perpetual inventory system. And what happens here is every time there is an inventory transaction, there is an adjustment to the balance in inventory. There still may require a physical inventory at year-end. Now, this is particularly good with barcoding, and that's the reason when you go in a store, when they scan something, what they're doing is taking that item out of inventory and putting it into cost of goods sold, and then, of course, looking to see do they need to restock. But we're not going to cover that part. Okay, we're going to look at 6 types of transactions. First, what happens when we buy inventory for cash? What happens when we buy it for credit? What happens if there is a purchase discount when we buy on account? Purchase discount usually allows a reduction in price based on paying early. What do we do when goods are returned? What do we do when a company receives an allowance to not return the goods? An example would be a company buys 100 blue caps and they're not the right color blue, and they go to the person they bought them from and they say, no, we don't want them back. You keep them and we'll give you 10% off. That is an allowance. The goods are not returned. And then we're going to talk about freight and how these are handled when it comes to inventory. Now we're going to walk through an example of each one of these types of transactions. First, we paid cash for 10 items at $100 each to be sold to customers. So what that means is they're going to debit inventory because inventory goes up, and we're going to reduce cash because the cash goes down. Now what happens if instead we buy 20 items at $100 each, but we do it on account? Now, on account means no cash changed hands. So in that case, it's still going to go to inventory, but the credit is going to increase our accounts payable. next thing we're going to cover is a purchase discount. A purchase discount may be received on purchases when a company pays early within a specified period of time. An example would be if you saw 2/10 N30, what that means is you get 2% off if you pay within 10 days, or you have to pay the total in 30 days. Now remember, that percentage can change. It depends on what the vendor provides. So in our example, you purchase 10 items on account, each to be sold to customers with terms 5, 10, and 30. So in this case, it's going to be 5% off if you pay within 10 days. We're going to use the net method, which means you must deduct the discount when recording the transaction initially at the point you bought it. So the first thing you got to do is figure out what amount you're going to book. So it would be 100% of 10 times $100 less 5% times 1,000. So the net amount we're going to book is going to be inventory $950, accounts payable $950. Now, what happens if we pay within terms? We're going to reduce our accounts payable and decrease our cash because we've paid it. Now, what happens if instead we pay after 10 days? We're going to still reduce our accounts payable for $950 because that's what's on the book, but we're going to increase our inventory cost by $50 because we've actually paid $1,000 for those goods. So it's an additional cost to inventory. Now, what happens when goods are returned? Say, for instance, 5 items at $100 each that you have not yet paid for, and there's no purchase discount. You've returned them. So what you're going to do is you're going to debit accounts payable, that's 5 times $100, and you're going to reduce your inventory. Now, what if instead you were granted a $75 reduction as an incentive to keep the merchandise? This is what a purchase allowance is. So in this case, it would be accounts payable $75, inventory $75, because what it does is, again, it reduces your cost of inventory. Now let's talk about freight. Now, freight charges. We're mainly talking about freight charges, and the focus here is who pays the cost because that determines who books it. And it all has to do is when does title legally pass. So if it says FOB shipping point, the buyer pays the freight because it becomes theirs the minute it leaves the company they bought it from. If it's freight on board FOB destination, what it means is it belongs to the seller until it is received by the buyer. So here's a demonstration. So what that means is if you're buying goods, you're going to pay the freight if it's FOB shipping point. You will not if it's FOB destination. So here's a little picture of what that looks like in terms of when title passes. So now we'll look at an example. Purchased 100 items for resale for $100 each on account with terms 5, 10, and 30 and $25 freight FOB shipping point. So where it's $1,000, okay, it should be 10. I had to fix my mistake there. All right, so it's going to be $950, and accounts payable is $950. And you're going to book the freight separately because we all know that you're going to pay that to a freight company. However, we're going to debit inventory because it increases the cost of the goods. Now we're going to do a summary entry that covers all of the things we just talked about. So in this case, we purchased 20 items for resale for $100, each on account with terms 310 net 30 and $25 FOB shipping point, and the seller is going to prepay the shipping. So to figure out the amount that we're going to book is it's going to be 100 times 20 gives us 2,000. We're going to less the discount. Remember, the discount never applies to the freight. And then we're going to add the freight, so this is the amount that we're going to book to inventory and accounts payable. Now, what if we return 2 of the items at $100 each? So we're going to have accounts payable is going to be the $200 minus the 3% discount. So we're going to reduce accounts payable, reduce our inventory costs. What if we paid the balance due in terms? It would be accounts payable cash. Now, how did we get that? You have to take the 1965. Remember to back out the item that you returned. So that concludes part 1.